Jenny. And welcome everyone. Today we have two excellent speakers who are going to share their information and knowledge about tax tips and preparation as we get closer to the year end. Joining us today is Eric Belligsrud from Compeer Financial. Eric grew up on a farm near Strum, Wisconsin, graduated from UW River Falls with a double major in ag business and farm management. He has worked as a loan officer for PCA, Production Credit Association in Mondovi, before moving into the tax department. In 2010, he became the manager for the Northwest region, and in 2016, he became VP of Tax and Accounting. He still continues to work with his family on their 2,500 cow dairy. Also joining us today is Corey Gertner, a tax accountant from GreenStone Farm Credit Services. Corey grew up on a dairy farm in Southwest Minnesota, where they raised brown Swiss and Jersey cattle. He showed cattle and poultry for 11 years, 4-H and FFA. He moved to Wisconsin in 2005. He's been with the tax industry for over 17 years, the last 3.5 with Greenstone. He has a great sense of enjoyment and pride sitting down with clients and helping them with their tax preparation. So welcome, please, Corey and Eric, to our show today. We'll call it our show, right? All right, gentlemen. Well, as we're winding down, it's now the second day of December. You know, we just saw news came out yesterday from USDA's Economic Research Service that says, you know, farmers are anticipating high cash receipts, possibly high production costs as well. So, you know, what kind of tips and advice can you give to farmers as they prepare for their year-end tax savings? Anything that they should be looking at, making sure they're doing as we get closer to year-end? We'll start with Corey.
There's a lot of things that we can look at. When I sit down with somebody, I look at what their current needs are, you know, and when we look at doing planning for the next year, my first thing that I look at are what are your inputs going to be required. We look at to see what the current cost of everything is, because then we can take that deduction right up front on the return. I walked into a scenario where I have a lot of people that have high debt from equipment purchases. Well, you can do the equipment purchases, it's no problem, but the downside is if you got to take out a loan for that $100,000 tractor, you still got to make those payments on that tractor. Versus if you have a line of credit to do your inputs, and we work through things in that respect. Eric, feel free to go ahead and jump in.
Yeah, actually, I just had a client today called me. I don't think I need tax planning this year. We really don't have any money in our checking account. I said, well, go look at what your loan balances were January 1st of 2021 and where they are today, and see what the debt is down. Well, they called me back about a half an hour later, and they're down about 100,000 in debt. I said, those principal payments are not deductible. And so you probably have more cash than what you think you have. So I kind of use that a lot of times just to see how accurate some people's records are too. It's kind of a check and balance that, you know, if they show a big profit and their debts haven't gone down, they haven't bought any machinery, it's like, well, there's the record's accurate. So that's just a real quick one to take a look at. So in the other comments, you know, as far as just, you know, just looking at your checkbook balance is not a good indicator of what the year is. So.
No, definitely. And I know for our small beef farm, and my husband's an agronomist, he's a little afraid of some crop prices. They've almost tripled, especially in some of the fertilizer costs. So are you having farmers call you asking about prepaying? And do you have advice for how farmers can prepay? Because I know there's some tax considerations and how much you can prepay for the upcoming year.
I have, and I had some people that jumped at the fertilizer about 2 months ago. They did a draw on their line of credit here with us to get some of that fertilizer on their books. As long as we don't distort the income and expenses too much from that, you know, we're able to go ahead and use that. If something happens, we don't need to, well, we can always push that over to the following year as well.
And we have quite a few dairy clients, and due to the CFAP payments that we got from the FSA office in 2020, we saw a very large amount of prepay in December of 2020. So that's another thing to consider, is that If they use an operating loan, again, paid off debt, that operating loan, but all those expenses were taken in 2020, they can't be taken in 2021. So that's another caution or flag to watch out for. So a lot of them, when I take a look at it today, they don't have much for fertilizer seed expense because they took it all in 2020. It's kind of all over the board as far as advice. What I'm hearing from clients, I had one yesterday and their co-op told them they don't have an inventory, so they don't even want to take prepay, honestly. And they're banking that they don't think they can go up much higher and bank on it's going to go down. I believe it was like 2008 that potash did that. This time of year, it was like $800 a ton. And by planting time, it was back down to about $450. So I think a lot of the suppliers are really cautious right now. How much inventory do you want to take on if it would turn around quick on them like it did that year? So it's kind of a wait and see. I know on the chemical side, I've got clients that have actually gone, if they were able to get their Roundup, they've bought it and it's in their farm. So usually I don't see clients taking possession of chemicals like they have this year.
Okay. Now, Eric, you also mentioned dairy farms, and that comes to mind because, for example, lime, on lime applied to alfalfa fields technically is utilized almost for the next 1, 2, 3 years. So do you recommend people deduct that full lime purchase in the first year, or do you stagger those purchases over the next couple of years?
Yeah, typically, we expense it out in the year that it's applied. You're correct. It does have a useful life, but you could say that maybe for some potash too. So, so typically we expense it out in the year of application.
Corey, do you guys do anything different?
No, I don't do anything different. When we look at the every other year, every 3 years that gets applied, that gets all taken into account when we set our long-term planning as to what we're going to do, how we're going to do it, what year are those particular costs going to come into play. I know when I got here, nobody had a long-term plan, long-term goals in place, and I feel that's something you have to have in place, because not only does it help you, but it benefits me as well in helping you achieve those goals.
So let's talk more about those long-term planning. What kind of conversations do you look at? Are you focused on income, expenses, or capital purchases?
Everything. It accounts from this point. If you came to me tomorrow starting a farm, my questions are going to be, what we're going to be looking at, kind of get an estimate of income. What are you farming? What are we going to be looking at for expenses? Get a feel for that. But outside of the right here, right now for tax planning, I'm going to ask you, Katie, what's going to happen 30 years down the road? You have kids that you might be planning on handing the farm over to. Well, if that's the case, now we need to plan for you to build in a retirement plan just the same, so that you're not like in a scenario that I just got done going through. The kids just took over the family dairy farm. There was no retirement planning, none of that long-term planning, long-term goals in place. And for them, the parents to retire just had to sell that land to their kids for $1 million. Do you really want to put that $1 million burden on your kids with all the normal day-to-day, and especially now with inflation kind of going haywire with all the expenses, to be able to still make everything happen, cash flow your payments, keep the farm going, and still plan for that 30 years down the road? And now that the kids are taken over, I actually just talked to the one a week ago, and she had made a comment that her husband had said that, well, let's just pay as little as tax as possible. And she's like, absolutely not. I am not going to do this to our kids, to what the parents just did to us. So you can get rid of that thought in your mind right here, right now.
Yeah, Eric, maybe you want to kind of elaborate on that misconception from farmers about paying as little tax as possible, because sometimes that's not really in their best interest.
Yeah, in the depreciation, going out and buying equipment, some of my younger clients, we take a look at it and like, if you want a 179, and what the 179 is direct expensing. So if you buy that $100,000 tractor, we can write it all off in 1 year. But if you didn't pay cash for that and you still have a loan on it, you're just kicking the can down the road. So yeah, we got out of paying taxes, but Uncle Sam is going to be waiting for you. And a lot of people just think that by doing this, we avoided taxes. No, you're just deferring the inevitable. And, in some particular cases, we have a crisis actually with some of our clients. They have a fair amount of debt yet, and there's no depreciation left. And it really limits our ability to transfer the farm to the next generation because we got such huge tax implications that unfortunately we're almost looking at the golden parachute of death in order to get out of the tax problem, because not only they need a family living, but now if you got to add the tax burden to it, it creates a real cash flow for that next generation.
And I'm going to add one more thing to that, Eric, as you said that with the whole depreciation game. I just sat here with somebody yesterday, kind of getting out, bought a brand new combine, was going to do some custom work for a couple of years because he's up there in age. Well, decided on Thanksgiving to list his combine in heads for sale. And the following day had $550,000 wired to his bank account because his combine and heads all went within a matter of hours. And as I punched the numbers in to get a feel for what his tax liability is going to be, right now projecting with all of his other income, he's going to be writing a check to Uncle Sam for $100,000. End of the day, it's only 20%. But to write that check for $100,000, if we can avoid that by not expensing the equipment, that's what we want to try and do. We recognize some here every year going down the road, and hopefully we can avoid that at the end. I know sometimes it's not possible to avoid, but by golly, we want to try.
Yeah, really having that kind of plan put together, talking with you guys as tax consultants before making the sale and seeing what's best in their best interest. Now, I know there's some proposed legislation that's still kind of going through the US Senate and House. Talked a lot initially about a lot of changes to estate planning. I think all of that has kind of been removed out of there. But, let's go back to planning for sales. The one that really kind of, I think, catches farmers by surprise, and maybe you guys think I'm wrong, is real estate. And, a lot of farmers bought real estate 20, 30 years, 40 years ago when it was cheap. And now real estate is not cheap anymore. So can you talk to me a little bit about that basis and that difference in there, and then why that tax really hits farmers hard? And maybe Eric, if you want to go first there.
Sure. So, it just all the chatter all summer was we're going to lose the stepped up in basis. And basically what we're talking there is if they bought that land, say for $200 an acre 30 years ago, and now it's worth $5,000 an acre. I mean, that's a tremendous gain that they would be paying if they were to liquidate it, sell it to their kids, whatever. And so with this, when I was talking about that golden parachute of death, basically in Wisconsin, because we're marital property, either the spouse passes away, they can get a full stepped up on basis. So upon the death, the other surviving spouse now has a basis of $5,000, the value of the property, sell it the next day and pay no taxes. Versus if they're both alive and want to sell it, they're talking about a $4,800 gain per acre. So the tax ramifications are huge. And that's why there was so much chatter, because if we lost that, on land, it wouldn't be quite so bad, but when it comes to machinery, and we've been 179 direct expensing everything, and they get a whole new full value on their raised cows and machinery, it's huge for that surviving spouse. And it sure makes it easier making a transition to the next generation. Unfortunately, that's not the way I like to say our plan's going. I don't like to set up a plan with somebody dying. That isn't a good plan as far as I'm concerned.
Yeah. Corey, do you have some comments or maybe some advice for planning?
No, and I agree with everything Eric said there. I know when it comes to land sales, if the land sales need to happen, we set up, and I got an attorney that I work with quite frequently. We set up extreme long-term land contracts because we look at what that gross profit percentage is. Using Eric's example, if you bought it for $200 an acre and you're selling for $5,000 an acre, that's a lot of money hitting the return. And the other thing that we have to play with these scenarios is Obamacare, because that's where most of people are getting their insurance when they're not old enough to reach that golden age of Medicare and don't have a spouse working off the farm. So there's a lot of playing around with numbers to try and hit those goals that we got to try and make to insurance, taxes, everything.
Yeah. And Corey, you mentioned Obamacare, and I know sometimes that year-end tax planning can look at maybe potentially some healthcare deductions. are you concerned with some of your farm clients right now and the impacts of these increased cash receipts on their healthcare options?
If we have any saving grace for 21 and 22, and let's keep our fingers crossed that they do make this permanent. Once you hit that upper tier, in prior years it had been, there's your cutoff. If you go $1 past that, you've got to repay it all. 21 and 22, they've got a reprieve where you're going to be capped at 8.5% of what your income is on the return. So you might not be having to repay all of that. But yeah, those are all things that we have to look at when we plan.
Yeah. Eric, do you have anything else on the healthcare?
Yeah, I would say we've probably been over the last few years, well, basically since the Affordable Care Act came about, doing more tax planning. And there again, this is why tax planning is so important, because there was the 400% of poverty. Well, a couple is about 66,000 of income. And you go over $1 over that, and you end up paying the full premium. And some of our, my clients that are, 55 and older, that premium, silver premium, it's could be about $30,000. Well, if you go over that, bang, they're gonna pay the 30,000. So for 21 and 22, it's kind of a reprieve here, capped at the 8.5%. I hope that stays, but because for our families, we have had to do maybe foolish 179 election, but when you're talking that kind of repayment on that premium tax credit, I mean, you had to do that just to get your back below that 400% of poverty. It's kind of foolish that whole healthcare became part of the tax issue, but it is, and we got to work around it. So
2020 would have been nice if we had actually known that they were going to forgive any Obamacare repayments, like they did in March. And I had one customer where they sold everything out and they knew they were expecting to hear that $30,000 balance due, because Eric, like you said, that's what the premiums were. So when I called her up and I said, you owe nothing, because I was able to make it work out, she's like, well, what do you mean we got to repay the Obamacare? And I said, not this year. They gave you a reprieve in March that you didn't have to repay that. And she's like, oh my God, I could hug you right now.
Yeah, definitely. Well, if any of our participants have any questions for Corey and Eric, you can feel free to unmute yourself. There's a chat option. Raise your hand if you're familiar with Zoom. We'll take your questions. Otherwise, I will just kind of keep firing. Speaking of, some of these tax changes, a lot of things that are out there. Oh, Katrina has a question. Child tax credit will have effects on farm taxes for families with young children. You guys familiar with the child tax credit? Any comments, Corey? I see you're nodding your head.
I was about to ask Eric if he wanted to go first on this one. I actually take those credits into account when we're tax planning with how much income to try and leave on the tax return, because I know in past years you've had to have some type of farm income in order to take advantage of it. So why not try and leave as much income as we can on the tax return so that we can take full advantage of what those credits are, whether it's paying for just the normal income tax or it's paying for the Social Security and Medicare tax on that farm profit. I kind of stepping back a little bit when I was talking about long-term goals and planning, even in a down year, I still want that tax planning, because maybe we try and defer as many December payments into January of the next year with an anticipation of an increase, so that we're still claiming some income on the current year tax return. Eric, feel free to continue on this, sir.
Yeah, you have a real good point there. When we talk about tax planning, everybody thinks we do tax planning to reduce taxes. And as we know, dairy was not so hot here not that long ago, and actually doing exactly what Corey said, basically, deferring some of the expenses into January, because we wanted our income to be up, because some of these credits, if we don't have income, we don't get them. And one of the things that, I'm a little fearful is people have gotten these advanced credits, and granted, they're bigger this year, 3,000 if you're over, 5 and 3,600 under, but they only gotten half of that now. And in past years, a lot of times we have children, we've been able to use that money to help pay their taxes. Well, they got to understand this year, they think their taxes went up, but they already got an advance on some of these. And the other advantage for this year, however, is in the past, you had to have income to get what they call the additional child tax credit. This year, they waived that. So the people are going to get it even if they don't have income. So But the only thing I'll say, there's going to be a letter coming out in January from the IRS, and make sure you hang on to this letter telling you how much you got for your advanced credits, because your tax consultant's got to have that or need it. Because I've heard, I've had people getting more than they're supposed to, and I've had people getting less than they're supposed to. So IRS has kind of a mess on their hands, I think, or we're going to have a mess trying to figure all this out. But, let's see what the letter says that they get, and that just confirms technically what IRS says they got. So make sure you hang on to that letter, and also try to remember what you got for this. As long as we're talking government payments, the stimulus payments, that was a real time killer this last tax season. People, could not remember exactly what they got for the stimulus payments, and we've got to have that to put that on our tax return as well.
Eric,
We
I
got
don't know
another
if you
round.
guys-
Yeah. Oh, sorry, Corey. I said we got another round of those stimulus payments in January, which seems like a long time ago because the pandemic is just extended. But there's some that came out again at the beginning of the year. So people got to remember, even though they don't think they got it in 2021, we did get another payment, correct?
Yeah, we got
Yes.
that third payment in, what was it, June, July, somewhere in there. The
Mhm.
January payment you're referring to, we had to reconcile in last year's tax return. So I had to call every single person under the sun to say, hey, what did you get in January? And it was the same conversation that be honest, it was a little redundant to say, well, I know you got it in January. IRS
Yeah.
wants it for this year.
Yeah.
So what did you get? So I can reconcile it and we can move on. To add with the whole child tax credit and the letters, I'm also, when I'm sending out the organizers this year, I'm putting a letter in because to reference that, so I can hopefully save one question on my phone calls when I touch base, but two, with that child tax credit and that letter, check your bank accounts. If you're getting everything direct deposit, make sure you got it. Otherwise, Eric, I don't know if you filled any of these out, but it's form 3911, which is putting a payment trace on the stimulus payments or what would be the missing child tax credit payments. My stepdaughter's told me that she hasn't gotten the last two payments, but I'm sure in the IRS's world, they sent them out. So I'm guessing we're going to have to probably do a payment trace to find out where they're at. I just keep my fingers crossed and pray that no more of this advanced stuff. Eric, I'm certain you are in the same boat, but oh my gosh, for simplicity's sake, no, thank you.
Yeah.
No, but I do think it is still proposed in the new legislation, at least up through 2022. But
Yeah, it is,
time will
but
tell.
I'm keeping my fingers crossed.
But speaking of accounting for things, Corey and Eric, PPP loans were a real issue last year. Some people still got PPP loans here in 2021. Can you talk about, when they received them, if they've gone through the forgiveness process and the expenses, and whether they need to track the expenses that were paid with those PPP loans? And we'll start here maybe with Eric.
Yeah, so the PPP funds were non-taxable. And, so technically, most of my clients, we waited until they were forgiven. And so all the expenses were deductible when they paid them with these funds. And so there are some questions out there, and it'd be more about, and I don't want to go too deep here because it will lose everybody, on S corps. If they don't have any basis in an S corp and they had a loss, they can't deduct that loss if their basis is gone. Well, with these PPP loans, it actually increased their basis because it was a non-taxable event coming into their, into their operation. So the other interesting one right now that we're kind of waiting for further guidance from IRS is the interest that got paid. So SBA government paid that interest. Is it deductible or not? So, you would think like, no, you never paid the interest, but yet at the same time, you got money to pay, these other expenses too. So we're kind of just holding tight. And some of these, it's not, like a very big amount. So, depending on how big their loan was. But I mean, if they had a $300,000 loan, it's still a fair amount of interest that the government paid for them. It might be a deduction. So I don't know, Corey, if you've seen anything more on that?
I haven't, and I'm in the same boat you are, just waiting to see what the guidance is going to be on that, but time will tell. Maybe by February 15th, right?
Yeah.
And the other thing, some of these COVID impacts that farm businesses might see is payroll tax credits, and as well as some sick and family leave credits. And so I don't know if you're seeing with a lot of the farm businesses that might have employees, if they have to be concerned about these things, they can go back and And I know like the employee retention credit, potentially you can go back and maybe take some of those. I don't know if you have a lot of customers, your clients you're advising on those topics. We'll start with
We
Corey.
haven't-
How about, or
Go
sorry,
ahead,
Eric.
Brian.
I was gonna say, I don't deal a lot with the whole payroll tax side. I mean, I know we've got some, and I know there's some that we got to go back and look at. I know a couple families that have, like, they employ their kids, but then there's always special rules for when it comes to family members and whatnot too. So we got to be careful with all of that going through. But yeah, I know I got a few I have to go back and look at. But I'm not really too much in that respect. Eric, I don't know if you've had more experience with that or what you've seen on your end.
Yeah, so on the dairy side, you got to have a 20% reduction in a quarter from the 2019. And so on the dairy end, we haven't really seen a lot of that if they have a pretty static milk production. Where I've seen it more so is I've got some cattle operations. It's kind of like all in and all out, and they vary the different quarters of when they all go out. And but some of those, they have such low labor amounts that they don't even know how to bother with the paperwork to do it. One of the other things that caught some people that did take advantage of it is they were taking advantage of if they were a corporation or S corp, paying themselves labor and family members. The IRS unfortunately came late with this ruling that you couldn't count those. So we had some people scrambling then to hurry up and get paid up or caught up again, because the penalties, if anybody's ever got caught paying a 943 payment late, it's horrible. It's like you could almost double your payment in no time flat. So.
And I know you guys, I think this past year with the pandemic, you never really had a slow time because IRS kind of keeps changing things and doing things. So we appreciate you guys being with us today, taking time out of your day. For those participants, if you've got questions, feel free, like I said, raise your hand, unmute yourself, or put it in chat. We'll certainly try and get those burning questions answered. But let's go back to year-end tax savings. One of the things that we kind of touched on this when we were talking about farm succession is people don't plan for retirement. So, if you have some of this extra corn that you've already sold, for example, or, you've got some extra money from dairy farming, which is probably not a whole lot. Is there something you can do as far as retirement planning? Let's start here with Corey, maybe.
So there's different options that you can do. If you're looking at just saving on your own, and it's just no employees, you've got a couple of options. You've got your regular IRAs, of course. You got a traditional IRA, which means it's all pre-tax. You got a Roth IRA, which is all post-tax. One's not better than the other. It all depends upon everybody's scenario. If we are looking at ways we need to get income off the return for just because the income is higher or Obamacare purposes, that has a direct effect with your farm is either what's called a simple or a SEP. SEP is a self-employed pension, which for self-employed individuals up to 20%. The simple, on the other hand, is a flat dollar amount. As long as you got it, it's right now it was 13,000. I don't know if they've upped it now for 2021 or not, or 16,000 if you are over 50. Both have their own sets of rules and such, so you have to be on top of that. If you've got employees, you have to offer those two plans to your employees just the same. So depending upon what's going on, and if you're a farm that makes money and you want to offer that as an option to your employees, go for it. I've actually had two people now this year that to keep their workers, have decided to start offering retirement plans. And both of them we've gone with simples, just with what they pay their employees and whatnot, and at least it gives them something and a little added benefit. Eric, want to go ahead and add to that?
So to add on to that, one of the other things they take a look at, there's a saver's credit, and depending on where your income, but it's all the way up to $66,000 of adjusted gross income that you can get a 10%, so it's like a 10% tax savings. Again, it's a non-refundable credit, but if you owe tax, you can use that, and we can get a credit. Now it's really tough to make this one work, up to 50% of the first $2,000. So I put $2,000 into an IRA, and the government's going to give me $1,000 back off my taxes. That's the best deal in town. That's a 50% rate of return the first day you do it. So But like I say, it's really tough to make that work to get to owe that much tax so you can utilize it. So definitely don't forget about the savers credit out there. Typically, when your income is that low, it's like I got about 100 other places to put my money, but it's still something to take a look at. And where we use the IRAs probably the most, and then throwing in HSAs, the health savings accounts for the Affordable Care Act, marketplace health insurance, it was another way to bring down our market or our adjusted gross income and get us back under the 400%. I mean, for the last few years, that was my saving, grace, like, oh, I really don't have the money to do an IRA. Well, would you rather pay 25,000 in premium credits? No, I guess I will do the 6,000 IRA. So just techniques like that, just everybody's got to be aware of those type of techniques to, save you some tax dollars.
And it's nice because you've got till the due date of the tax return to make those contributions for that traditional IRA, for your simple, for your HSA. And the SEP is the oddball because that actually gives you through the extension deadline if you file a timely extension.
So that, our traditional tax filing date, well, technically for farmers is what date, Corey?
Typically, if you don't do estimates, you should have them filed by March 1st. If you make your estimated payments, then it's April 15th like everybody else. And that's another thing too, is I've been trying to get everybody switched over to paying in the estimates. You don't have to do them quarterly. Farmers can make a one-time estimated payment January 15th. So you still got 6 weeks to decide if you're going to do that or not, of 2/3 of what your estimated tax liability is going to be. Now I've done it where I split them up into 4 payments because as well as I do, it's easier to write out, say $2,000 a quarter versus, well, gee, there we go. Now I got to write out my $8,000 check. But I look at it from a cash flow standpoint, when you may or may not have the money. So, you may have the money first quarter, second quarter, third quarter, but fourth quarter comes around, things are tight coming into the new year. Well, you can skip that quarter because you've already got your 2/3 requirement paid in at that point and can finish it with the tax return.
Yeah.
And that all goes back to the whole circle of planning with everything.
Yeah. Are you offering the same advice, Eric, as well for your clients?
Yeah, and especially when I got a situation where I know their tax liability is going to be higher. Say, for example, this year, we could pay in 100% of 2020 tax, and it's a lesser of the two. And so if, say, for example, their taxes are going to be $15,000 more, we just push that deadline. Granted, they got to pay that January 15th, but the rest of that payment does not have to be made till April 15th then. So the other thing I was going to mention on that, the people to watch out, basically anybody that I have that have investments now, they're coming later and later all the time. So we're supposed to be there by the end of February. Well, the returns due March 1st. So that's just putting a burden on the tax consultants to, and tax industry to get these done. So anybody that has kind of any investments at all, basically we're pushing them. You got to either make the quarterly or the January 15th just to buy us some time. And same thing if they got K1s or any other investments, that's the way to do it. One other thing I'll mention on that with the changes of the like-kind exchange on machinery, we're catching people that are no longer considered farmers. They're not meeting the 66% of gross income being agriculture because machinery trades don't count. It's like investment income. And so we're catching some of these people are falling off the eligibility of a farmer. It seems weird, but you'll get caught and IRS will catch it in a minute. You get a 1-year reprieve, but after that, then no, you're expected to be paying in quarterly. So it's just something to keep in mind because when we start doing these trades on a combine or a tractor that they give you $100,000 trade-in value and it's all depreciated out, that's $100,000 of extra income. And depending on what your Schedule F income is, and the wife or husband's working off the farm, it doesn't take long and you're not meeting the 66% of ag income anymore.
Yeah, maybe Corey, you can talk more about that, the changes in like-kind purchases, like-kind exchanges there.
Actually, I haven't had too many people that, well, let me back up. I guess what I've been doing in the last couple of years is when they've traded in a piece of equipment, we haven't really done it as a like-kind exchange. We've treated it as a sale and a new purchase all over again. And that way, if there's some basis left in that equipment, you know, we may be starting all over with a new piece of equipment on that depreciation schedule and making it work to our benefits.
Sure.
Sorry,
Well,
Adam, I just lost
Oh, that's
it.
okay. Yes, it's just some of the federal laws have changed. And that's the way now to treat it as compared to previous laws. So Eric,
Well,
yeah,
the
go
oth-
ahead.
Yeah, the other comment I'm gonna make on that, whether you call it good or bad, it's gonna be bad when you get to be 65 or 67 full retirement age.
Mhm.
But what happened doing this is now that I gotta treat this as a sale and then I get the new asset as a full value. So that 100,000 they gave me for that old tractor, I sell it for that 100,000 if it's all depreciated out. But I do get to add that 100 onto my 100 of boot. So now I got a new tractor for 200. Well, then I look at my tax return and like, good grief, I'm not paying taxes on that $100,000 gain. So the only way for me to get rid of that is 179, my new tractor on my Schedule F. And all of a sudden I've got a Schedule F now that's got like a negative $75,000 to get rid of that $100,000 gain. I'm not paying any Social Security tax. Yeah, I'm saving the 15% in the Social Security tax. But, as I get clients now, they're getting 55 and they get their Social Security statement, it's like, holy cow, look at how terrible my Social Security is going to be. Well, yeah, you saved that money all those years. And what I've told people, if you want to save the money, that's when you need to be doing something else than the SEP, the IRA, do something to offset that. Because yeah, you're probably going to be getting less Social Security when it comes time for Social Security. So.
Right. It goes into that misconception about farmers never wanting to pay any taxes. It kind of comes to bite
Yeah.
them when they get up to that older age, certainly. And in case we lost people, don't worry. That's what your tax consultant is there for. They're the ones to figure out all those federal changes with the IRS and to help you figure out the boot, the capital gains, and how to make that all work. So that's why you really do need to find great people like Corey and Eric to help you do your taxes. Make sure that they're helping you with that. So if you've got any questions in particular, feel free to put it in the chat. We've got about 10 minutes left of our time today with our tax consultants. We're kind of wrapping up some of the questions I had. The last one on year-end tax savings, guys, is going back to, it's not really necessarily the increase in the quantity of corn that was sold this year, but it's the price. That price of corn is still kind of staying up a lot higher. So we're hearing people that have delivered corn that maybe are selling under contract, or they don't want the check until 2022. Now, there's certain rules according to the IRS on how you do that. And maybe Eric, you can talk about a little bit of what's the right way according to the IRS to sell under contract.
Yeah, we have, I have clients that say, well, I got a check and I threw it in my desk drawer. Can I defer that? Well, no, you've actually got physical possession of the check. It's your problem. You didn't take it to the bank. So what I recommend is having multiple contracts. And the reason I do that is because IRS allows you to opt out of a contract. And so if we find out that we need more income, we can pull that out. Now, if you go and get one contract, it's all or nothing. So I want as many a contract, don't go crazy with it, but have some smaller ones and maybe some bigger ones. So if we need to pull some more income back into 2021, we can do that then, because if we got a contract it's like worth $15,000 a grain and we have another 75,000, we can defer those 75 to 2022, but we can pull in that one and get our income up in what we call the sweet spot. And again, I can't, stress enough, anybody can do the tax return in January, February, March, April, but it's the tax planning. I still feel it's the biggest benefit anybody can do. So going into the year what strategy you need to put in place by the end of December so you can get the tax outcome you want to have.
Yeah, Corey, do you have anything to add on that?
Well, and this actually happened last year. If you're going to throw that check in that desk drawer, please do not forget about it, because I had somebody all figured out. In November, we were good. And all of a sudden, I get a phone call from the one brother that the other brother sent on $250,000 of grain checks. So that completely shot all my numbers out the window. Elevator was kind enough to do some of those quote unquote deferred contracts, probably not exactly 100% legit, but this was the week before Christmas. And so there was very little time to figure out what we wanted to do with that. But yeah, just make sure you're on top of everything. When you get that check, that you're depositing it, your tax accountant knows about it, or, accountant knows about it, who's doing your books. Because that's just going to help us more at the end of the year to make sure that we've got that plan in place. And Eric or I were not sitting there doing the return and we're going, where did this come from? And now we get to have the fun conversation of, well, since this was forgotten, this is what happened, and here's your balance due, and our options are X, Y, and Z to try and help you out at this point.
Yeah, and that kind of goes back to that cash flow issue, like you were talking about before, Corey, and trying to make those payments, stretch it out a little bit, and that's where that planning really comes into place there too, for sure. So, and having those contracts, I know in my husband and I's case, in our farm, we've not necessarily prepaid some of our crop inputs, but we booked and we tried to lock in the price. And I think the co-op was receptive to that. Now they know how much inventory that they're going to have to look at, because Paul Mitchell, our economist at Madison, kind of said they're not quite sure on supply for next year. And I think you guys were kind of talking about that too. So some other good tax saving strategies. But anything else you guys want to talk about that I might have missed today?
Well, one other one that's really easy for people that have children is paying the children. If they're under age 18, you don't have to pay Social Security. Of course, I just got done telling you, watch out so you don't pay Social Security. But this is a free expense. Basically, the money stays at home. They can pay for their own school supplies. They can make, for 2021, they can make $12,550, assuming they don't have any other interest income and stuff like that. And the farm will, assuming it's sole proprietor, who does not have to pay any Social Security tax on that and state tax. So when you start taking a look at that, if we have a profitable sole proprietor, even at the 12%, federal tax, 15 Social Security, and 6 state, you're talking a 33% savings in taxes, all legal. I mean, assuming the kid is working, we got to, we want the kid working, the child working and doing that. So, and then some of the other things, just to talk about with the importance of tax planning, a lot of these credits, there's phase outs, even on these stimulus payments. Some of the things we had to do to get income down, because if your income was over a certain limit, you didn't get that $1,400. If it was over 160,000 adjusted gross, no stimulus check. The child credits, tuition credits. There's so many of these credits that sometimes we take a look at it. Does it make sense for a long range plan to do this? But the kids are only kids so long, and they're gone before you know it out of the nest. And now those credits are gone. So it's kind of like take them today or lose them. And the other thing there too, the standard deduction, you want to take advantage of, have enough income so you use, at least you're using up that 25,000 standard deduction. So when it comes to tax planning, there's a lot more to it than meets the eye. So I just wanted to point that out, just some of the other tips that we look at.
Eric, I'm going to add one little thing. It said $12,550 is a standard deduction for federal. Wisconsin is not that high. So if you pay your kid the $12,550, just keep in mind, you will have a couple bucks to pay for the state of Wisconsin. And I mean, if you forget to file that state of Wisconsin return, they like to hit that $50 late filing fee no matter what. So just be aware of that.
Yeah, good point.
Well, good. I don't have any other questions at the moment. So you guys have any closing thoughts? Corey, we'll start with you.
Find somebody that you can get with, trust, have a normal conversation with. I mean, I've actually gotten to get to be some close friends with some of my customers, not intentionally, but we have, because we talk all the time, going back and forth, just making sure we're on top of everything. And they put their trust and faith into me. And so I want to know the ins and outs of everything. I've visited their farms, I've seen everything to what's going on. And, it's what I mean. I have fun when I do this. It's a fulfilling experience for me to be able to help my customers get these plans in place and to meet those goals and do the best that we can.
Yeah, great. Well, thanks so much. Corey is with GreenStone. And I'm sure we'll have his contact information and there's quite a few staff, I'm assuming, with GreenStone that would help farmers, not just you, Corey, as well as, Eric is with Compeer Financial and has quite a bit of staff down there as well. So Eric, any closing thoughts that you want to share with us?
The only other thing that I get asked a lot is the difference between the traditional IRA and the Roth IRA. And so the traditional, you get a deduction going into it on that tax return. The Roth, you do not. The advantage of the Roth is it continues to grow tax-free. So the day you come to retirement, you'll wish you had all Roth because they'll be all tax-free. So all that growth is tax-free. So one of the things that happened with the down years in agriculture 3, 4, 5 years ago, we took a lot of IRAs, traditional IRAs, and rolled them over. And these people are really happy because since that time, this not only we could have an NOL, but this way we rolled them. The stock market has grown substantially since then. Not to say they couldn't take a dip, but these dollars now that were in their traditional IRAs are all in Roth now. And so typically I tell clients if they're in a 12% tax bracket, seriously take a look at, that isn't that great or bad of a tax. Yeah, it still stings 12%, but to be able to put that into a Roth and let it grow tax-free for retirement, I still think you can't hardly go wrong on that. So.
Yeah, definitely.
All part of the numbers game.
Yes. And I, as in farm management and financial and these guys in taxes, we love our numbers. Farmers, not always their favorite activity, but that's why we have great tax consultants and preparers like you guys and other staff at both Farm Credit Services here that we have on today. Want to thank you guys very much for your time. Hopefully for the participants that were watching or will watch the recorded video, it was worth your time. Got all your burning questions answered. But if not, we'll get the contact information out. I am Katie in Dunn County, and I will turn it back over to Jenny Vanderlyn with the Center for Dairy Profitability. Thanks, guys.
Thank you.
Thank you.
I had to unmute myself. Sorry about that. So thanks, Katie, and thank you very, very, very much, Corey and Eric, for taking the time today and joining us and giving your insights on the tax preparations and issues that you're seeing. I learned a few tips myself, so I do thank you very much. For those of you still online, resources that, like Katie had mentioned out for Corey and Eric, their contact information will be put out onto the Heart of the Farm website, as well as the video probably within a week's time. We'll have that available for you to review and for others to watch as well. We thank you for attending today. And if you haven't already, please sign up for the other coffee chats that are coming up. For January, we have Steph Plaster, who's the county educator in Washington and Ozaukee County, on strategic thinking and planning for your future. In February, we will have Sam Zimmerman and his wife Jennifer talking about their beef farm and marketing some of their products and stuff like that. I'd also like to remind people about our Farm Ready, UW Extension's Farm Ready research webinars that are coming up. I believe, okay, do those start on the 17th or the 11th of December with a leasing agreements? But we have those running through April, and you can find out more about that by going to the UW Extension website under Farm Ready Research. So with that, I would just like to thank you all again for participating, and again for Corey and Eric for joining us today.
Thank you for
Thank you
having
very
us.
much. Thank you.
Yep.